It's Friday, July 24, just after market close in New York. This is the Real Vision Daily Briefing. I'm Ash Bennington in New York, joined shortly by Max Wiethe. But first, Jack Farley with the day's stories.
Thanks, Ash. In Europe, the PMIs are showing signs of a continued recovery. The numbers coming out of Germany and France are looking particularly strong. Meanwhile, the US reported its PMIs today, and they were nowhere near as robust. The services PMI increased to 49.6, while the manufacturing PMI reached a 6-month high of 51.3. And the composite figure of manufacturing and services together is right smack in the middle at 50.0. Remember, a reading above 50 indicates a growth in output. So the fact that the composite figure was right at 50.0 means that the private sector is exactly on the knife's edge between an expansion and a contraction. In the world of residential real estate, we did see some promising news with sales of previously owned homes up 20.7%, but renters and landlords are facing an entirely different set of challenges. The missed payment rate continues to inch higher. It's now at a record of 32%, meaning that for the first month in July, almost 1 in 3 renters failed to pay their full rent. By the way, during that period, renters could turn to unemployment benefits, but these programs expire this Sunday. And over the next week, over 25 million Americans will be cut off from this assistance. In other news, the Bank of Russia lowered its key rate to a record low of 4.25%. Oh, and also, Goldman finally settled its 1MDB case with Malaysia, but the stock price barely moved on the news. And Brooks Brothers received a bid from the Spark Group to buy the bankrupt entity for $305 million. That's quite a tidy sum, but there could be other suitors. It's rumored that the Italian Giglio Group is going to make an offer. But all eyes are on WHP Global, a syndicate of funds from BlackRock and Oaktree, the big players. Will there be another bid before the August 5th deadline? That'll be the interesting question going forward. And lastly, gold rides higher, soaring past the 1900 level to set a new record. Meanwhile, the DXY continues its slide. If you're interested in these topics, there are 2 Real Vision interviews that you need to watch. One is Hugh Hendry and Luke Groman, who did a masterclass on the dollar. That came out today. And then on Tuesday, the great Lynn Alden will be back to provide an update on her views on gold, silver, Bitcoin, treasuries, and of course, the almighty dollar. And with that, let's go to Ash and Max.
Thanks, Jack. Welcome back, Max.
Thanks for having me, Ash. I know maybe some people are disappointed that I'm not Ral, but I'll do my best.
Nobody's ever disappointed to see you, Max.
All right, if you say so.
So, Max, I understand you're looking at the S&P, the precious metals complex, and the dollar. What are you looking at today?
Well, I just think that those are interesting things this week. Obviously, we saw massive runs up in both silver and gold. Silver especially with a couple of 7%, 5% days, which is a pretty massive move for silver, breaking out of some major ranges. And then gold as well, hitting 1900 overnight last night, approaching all-time highs with the sort of macro tailwinds I think everybody is pretty well aware of with printing and fiscal spending going on. So I just think that that's really where the action is. And then as well, it's not just the S&P, it's the S&P in relation to the dollar and inter-asset correlations and how they tend to change. Recently, I think maybe a couple months ago, on a week like this, you would have expected to see the dollar sort of spiking with risk off action in the markets like we've seen. I think we're down in all of the major indices and pretty much across the globe. And the dollar has been sliding. So, that's a big change from the dollar as being this pretty simple, we're going risk off, go to the dollar for safety. And I think that that's telling for where it might be headed. So that's really what I've been watching. And correlation as well. I talked to Greg Weldon today on Real Vision Live, and it was really perfect to have him on because he tracks everything, but he's well known for his commentary on precious metals, and he's pretty bearish on the dollar, and views it just as a tide that's going to raise all boats in the commodity space, but specifically looking at gold and silver. And he was giving some pretty lofty price targets for both of those metals, but then also other commodities in general. So I think that that's an interesting place to be.
Yeah, Max, that's a broad and comprehensive introduction about how all of these things relate together. So, for those of you who aren't following this as closely as Max is, DXY peaked in March at 102 spot 99 and is now basically slightly above the 52-week low at the close today at 94.41. I'm curious, I don't follow the silver market very closely myself, and I'm curious, why is the action there? What's the distinction from gold, and what is it that you're looking at when you think about silver?
Well, the distinction is that it's not purely a monetary metal. It's also a industrial metal. So there are more factors that I think go into its pricing than just than just what is happening in terms of monetary policy and macro. I mean, it isn't always mined. Some of it comes from reuse and recycling. So there's just a lot of different dynamics. Nobody's pulling gold out of like the gold that comes into the supply is coming from the ground. It's not coming from recycling.
Right.
So there's just like a lot of different things. It was more that it had been, it's been running up recently, but this week was definitely a huge move in the metal. So that's why people are wondering from a tactical perspective. You find yourself in these types of scenarios where if you were in the position, you might be sitting on a lot of profits and things have run very quickly. And if you haven't been in the position, but you believe in the thesis, which I think a lot of Real Vision viewers do, they understand what the consequences of some of this fiscal and monetary policy can be. You might be having a little bit of FOMO, and things don't go up in a straight line all the time, and there are pullbacks. And so it's really just a moment where you should be having that question of, is it time to take risk off, or is it time to be a pig and go for those sort of home runs? And in talking to Weldon, he was, as I said, he put some pretty lofty price targets and definitely falls on the side of this is not a time to be, de-risking yourself. But everybody's time frame is different. Everybody's entry point is different. So I don't have the answer for everyone, but it's something that I'm thinking about.
Let me jump in there. Actually, you were talking about monetary policy and fiscal policy in relation to the aggregate performance of the U.S. economy. It's been a relatively busy day in the news cycle. Some interesting things. The thing that caught my eye, and I'm curious to hear your view on this, Max, is so Bloomberg did a fairly extensive piece today talking about the U.S. Economic recovery stalling. The word they used was stalling, and they looked at this from a broad variety of domains. They talked about credit card spending declining, air travel, restaurants, but mostly what the piece focuses on is how the rate of improvement in the jobs recovery, as measured by the rate of improvement in initial claims, has declined, effectively flatlining in terms of that recovery effort. I'm curious what your thoughts are and how your view of the things that you're watching is either driven by, impacted from the broader U.S. economic cycle.
Yeah, so I'm not much like a lot of the commentators who come on Real Vision's daily briefing. What's happening in the equity markets doesn't make a lot of sense if you're looking at this sort of broader economic data. But it does. What we're seeing with the slowing of the improvement makes a lot of sense. When you go down as low as we did, you are going to see a bounce. And it's a lot of kind of like what I was talking about with silver. Like when things happen that fast and that dramatically, there has to be some sort of exhale to the move. And what we saw with the bounce was exactly that. But I think we're obviously not back to normal. We're sitting here talking over Skype. I'm in a different city from where I normally live. It's not going back right away. And I think anybody who thinks that who legitimately thought that we would have a perfect V-shaped recovery that brought us all the way back was just insane. I mean, it's par for the course for me. It makes a lot of sense.
Yeah, and talking of the recovery and the jobs recovery, I was just reading Mish Shedlock on thestreet.com, and he does this fairly extensive analysis of the federal pandemic unemployment compensation programs, the FPUC, and he walks through this kind of alphabet soup of programs from the Department of Labor. And his takeaway essentially is that 30 million people are about to lose the $600 in unemployment benefits that have been added as a result of the COVID pandemic. His analysis is higher, meaning worse than consensus. Most other outlets are pegging that number at closer to 25 million. So he's above consensus, meaning a worse impact from that. It's interesting to think about that when we look at the stasis in the jobs market, and then we look at how this program is clearly going to be rolling off soon unless it's approved. The other thing that I thought was really interesting today was this story about Mitch McConnell, and the GOP seems to be in a little bit of, well, I don't want to say chaos, but maybe disarray. The coronavirus aid that FPUC that we were just talking about is about to expire, and there seems to be substantial disagreement in the GOP congressional ranks about what to do next. You know, I'm not a policy wonk. I'm not someone who totally geeks out on what happens in Washington. But what's interesting to me is Mitch McConnell, to his supporters and his political opponents, has always been seen as a master of parliamentary procedure, as someone who's always one step ahead of the competition in understanding what's happening in the legislative process. But here, frankly, he looks a little bit flat-footed. And when you combine all of these factors, the deceleration of the jobs recovery, the rolling off of $600 a week for 30 million people, potentially, maybe 25. Ms. Shedlock has it at 30 million. And then you add this legislative stasis. It really is a recipe for deceleration in aggregate of the U.S. economy.
Yeah, I would have to agree. But I think what you're seeing is sort of a reconciliation with their sort of party line of old, and maybe what I don't want to say it has to be done. I'm not trying to prescribe policy or anything like that, but there are a lot of people out of work, and it's been pretty clear that this increased unemployment insurance has made its way back into the economy. So you can talk about whether that's the good thing for the long term, but if it falls off, it is going to have an effect, and a pretty immediate effect. But at the same time, the GOP is the party of let the economy do the work and let it pull us up, and a strong economy lifts all boats. Like we need to open. So it's a conflict between what are their core roots as a party and what their voter base believes with what is a very unique situation.
Yeah, you know, speaking of things that that supporters and opponents both agree on, in this case about President Trump, it is that he is not a typical Republican. He does not cleave to the traditional Republican laissez-faire views in many ways, and maybe we're seeing some of that split reflected in Mitch McConnell's positioning on the coronavirus relief packages.
Yeah, and in some ways, maybe it's a bit of posturing for what happens post-election. You know, if people are predicting that Trump is going to be out and the Republican Party is no longer going to have him as its main leader and driving force behind the policies it believes in, considering like, wait, is it time for us to try and reset and go back to some of the things that we had before? Do we want to go back and be the policy of fiscal responsibility again? So I wouldn't be surprised if the election and the potential, not removal of Trump, but like not having Trump in the White House is making some of these things pop back up onto their radar in terms of fiscal prudence and responsibility.
Yeah. You know, I'm interested, Max. We started out the conversation talking about some of the things that you're looking at, specifically U.S. equity markets, the U.S. dollar, and the precious metals complex. And then we shifted here to a more broader macroeconomic and even politico-economic conversation. So my question to you is this. Do those two conversations in your mind relate at all? In other words, when you think about the things you're watching, and then we have this conversation about macroeconomics, the recovery, and the current political situation in the U.S., do you see those things as linked at all? Do they feed into your analysis, or are you looking at it as something that largely has its own rather fundamental and technical momentum of its own?
I'm going to give you a half answer, which is that it depends. So it just depends on the time frame that you're talking about. I know, Tyler is a big flows guy. Like it's all about flows and what the whales are doing. And a lot of the things that it's like a huge pet peeve of mine. And we talk about it on the editorial team all the time is, such and such happened in the markets today as this headline happened. And although the people writing those headlines are doing a very good job of limiting their downside risk by saying as, not because of.
Right.
The implication of that headline is that those two events are connected. So I would say that on the daily basis, the idea that what is happening in the markets and what's happening in precious metals and with the dollar is because Trump did XYZ thing. And there are obviously exceptions to the rule. It's not a coincidence if massive things, massive moves, say in the dollar happen like on the day that like we go to war or
Right.
headlines can factor in.
The ultimate weasel word to look for is amid.
Amid, yes.
When you see amid, you know that there's I've used it myself.
Yeah. And look, the idea that like we all knew that this fiscal cliff, so to speak, with the $600 was happening. Is it going to work? Let's say it doesn't happen. $600 goes away, just for our sake of our argument here. That will work its way into the economic data, and that will work its way into probably into prices eventually. But it didn't for a period of time. The market was round.
Max, all very well said. You mentioned also another point that I think is really critical, talking about differing time horizons, differing time frames that you're looking at the market over. I'm curious, what do you have a particular time horizon right now that you have conviction on in a particular direction for one of those asset classes? How are you looking at it, and what is the interpretation that you're bringing with regard to time horizons?
Full disclosure, I'm short the dollar on a relatively short time horizon, like 2 to 3 months. And that's around the time frame that I like as an investor at this moment in time. But at the same time, I really am like that interview this week with Beneat Kathari, that idea of taking long-term views on a very small number of companies, that makes a lot of sense to me too. That's not how I'm positioned or what I'm looking at, but I think that there are many different ways for people to be investors. And
it's a great interview as well in terms of looking at things from a longer term time horizon. In fact, that was the piece that I liked this week and spoke about during our new podcast where we talk about the content at RVDB. Question for you from the dollar, again, getting back to today's news flow. Escalating trade tension with China. China ordered the U.S. to close its consulate in Chengdu province, presumably as retaliation to the Trump administration ordering a Chinese consulate in Houston to close. We've got mutual allegations of espionage, stealing research. And just as we were coming into the close today, it crossed the wire that the U.S. just arrested a Chinese scientist who'd been hiding at the Chinese consulate in San Francisco. This is the second largest bilateral trade relationship, with the U.S. after the EU, but it counts for roughly half the U.S. trade deficit. What are your thoughts in that in relation to the dollar?
I actually don't have any thoughts in relation to the dollar. So, a lot of the positioning that I'm taking right now is like we are seeing things disconnected from headlines.
Right.
It's more general framework and letting the charts speak to me. And just looking at trends and being a trend follower, waiting for confirmation that the trend has ended. So, those sorts of things long term could play into the dollar, but the dollar move happened long before that event, before trade tensions came back up, and the price action, at least intraday, didn't reflect any sort of effect. So it comes back to that idea of like different time frames, and I think that a lot of these events that people talk about that do have effects on markets, they don't match the time horizon that people are assigning those effects to them. And so it's not on my radar.
Yeah, to exactly that point, Max, and what seems to be almost emblematic of that is I don't know if you were following this 1MDB settlement today from Goldman. So basically, Goldman settled with Malaysia for $2.5 billion in cash, an additional $1.4 billion to cover potential shortfalls if asset forfeiture sales fetch lower prices at auction. Total fines plus legislative settlement, potentially $4.5 billion to Goldman. They're obviously going to need to increase their provisioning for legal and regulatory exposure. Some market participants and analysts had estimated the total exposure as high as $10 billion. Goldman traded up a bit earlier on the day on the notion that the uncertainty had been removed. No one likes an unquantifiable hit to the balance sheet looming out there in the future. And then it mean reverted, and we closed on the day down 1.55, so off less than 0.75%. In other words, markets just shrugged.
Yeah, exactly. So, something happens and then the move happens and everyone's like, see, this headline caused this thing to happen. And then you get a headline and nothing happens. Everyone's like, well, it was obviously priced in. It was just so obviously already priced into the stock. So it's,
yeah. Listen, I don't want to be flippant about it. In this case, it may be the fact that there are just broader secular trends that are overpowering the potential for news cycle movement on some of these names. It's possible that under less extraordinary circumstances that we would see movement more correlated to news cycle headlines. It seems that right now, and I've been watching markets for a really long time, it seems that right now there's more of a disconnect, to your point, than I can remember seeing for some time.
Yeah, exactly. I'm just not really too focused on the headlines, but there are some things. That doesn't mean I'm not paying attention to what's happening, and I do think that moments in time are important. And specifically in equity markets right now, I think we're going to get some answers whether in the coming weeks we see a bid back up under the market. I mean, this is first couple of down weeks in a while. The equity markets tripped up in June, and since then it's been running hot again. So I think that these coming weeks are going to be big for us, with the combination of the things that you're focused on with CARES Act rolling off, and just seeing whether we're able to catch a bid under this market. So I'm in kind of a wait and see mode over the next 2 weeks, but I think we're going to get a lot of good information from the price action.
So first question, Max, which U.S. Equity market index are you most focused on and why?
I watch them all. They tell you different things. But prior to this, I used to say, like, anybody who quotes the Dow in points, like, just a joke, like, get them out of here. Like, I don't pay attention to the Dow at all. S&P 500 was pretty much all that matters. But because of the fact that there are winners and losers from this coronavirus in terms of companies, and trends are accelerated. Obviously, the NASDAQ has come back into my purview. I pretty much for a while just looked at the S&P and the NASDAQ as, they move together for the most part.
I mean, not a whole lot of momentum on the S&P this week. It's off fractionally, I think 0.3%.
There's not a whole lot of momentum. It went up this week, earlier in the week, but couldn't keep its head up through Thursday and Friday. And that's what I was talking about on the back half of the week, where I would have expected potentially for my views on the dollar to be wrong and to see some bounces. And the fact that we didn't was like, that's the type of thing that I pay close attention to, is when correlation that has been happening it breaks down. And that's what I'm looking for in markets, is things that are different,
So to that point, what correlations are you looking at most closely right now, and why?
So gold and equities, like, for instance, when we first started selling off, gold was falling. It was part of the risk off sell-off. And I think a lot of people have been cautious of, when we see another sell-off, will gold go with it? And we're not seeing it. Gold had a great week this week when markets had some choppiness, and gold was strong, and it kept its head up the whole time. Like, that's a change that I think is notable and something to pay attention to. Same thing with silver. Like, silver was pretty highly correlated with emerging market equities, and you could see that, but not really seeing that this week. So when those types of changes happen, those are the types of things that I pay attention to.
Yeah. Max, I think we're going to have to leave it there. Any final thoughts?
No, I just, I'm in Cleveland, Ohio. I'm headed back to New York soon, so I'm excited to head back to your neck of the woods. Can you give me a little bit of a preview into what I can expect? What's life like in the city?
Lot of boarded up shops, and it's very strange. It depends what neighborhood you're in. Here, where I am on the Upper East Side, looks pretty normal. A buddy of mine, reporter friend, went down to the financial district yesterday, and it said he thought he was expecting to see something that looked more or less like normal as it is in his neighborhood, and he said ghost town. And it showed me some pictures of the New York Stock Exchange and the ferry, and it is just absolutely deserted down there. So it's kind of a neighborhood by neighborhood basis. But it is definitely not the New York City that we have come to know and love.
Well, I'm excited. I'm in the market for apartments, so who knows? We'll see which neighborhood I end up in.
And if you're in the neighborhood for outdoor drinking, you've come to the right place.
Yeah, I was talking to Nafal Sanala a few weeks ago, and he's based in Brooklyn, and he was saying, people are outside, they're riding bikes. It's like Paris and Brooklyn. So I don't know, maybe some Parisians would disagree, and we just offended all of our French viewers. But I'm excited to come back and see what it's like. A lot of people are scared, but I fled to Ohio just to have cases spike here, and now it's more dangerous to be here than it is in New York. So time to go back. Hopefully I don't bring it with me.
Max's issue of Death in Samara. Well played, sir. Max Wiethe, thanks for joining us.
Thanks for having me, Ash. A lot of fun.